Hi, this is Jane the Thoughtful Avatar. I am not a licensed financial advisor, so this video is just for educational and discussion purposes. Today, I am looking at the biggest misconception people have about inflation, which is believing in only one inflation measure, when there are actually two, and often working in opposite directions. The first measure of inflation is consumer inflation, which includes things like the price of food, gas, rent, and generally everything that the consumer needs in his everyday life. For some context, I will tell you that consumer prices rose at an average rate of 4.6% in the last 5 years. The other measure of inflation is asset inflation, which measures increases in prices of assets, such as homes and stocks. In the last 5 years, the S&P index rose at an average of 14.4% per year. For comparison, the median home rose in price 6.5% annually on average over the same 5 years. Now, asset inflation has many components, because assets are numerous and diverse. Homes and stocks are the main ones, but there's also gold, bitcoins, foreign stocks, collectibles, art, etc. There is no single measure of asset inflation that takes into consideration all those assets, such as the CPI for consumer goods. To simplify things, let's focus on the main two components, which are housing and the stock market. While both of those are up over the last 5 years, as were consumer prices, we notice two significant differences. First, assets have appreciated significantly more than consumer prices. And second, while every year saw increases in consumer prices, the same cannot be said about the S&P, which went down 18% in 2022, and homes, which were down in each of the last 2 years. Let's start with our first observation, namely that assets are currently rising faster than consumer goods. Assuming wages generally keep up with inflation, that means the poor are getting poorer, as their income is getting insufficient to buy homes and stocks, whereas the rich are getting richer, since they own the homes and stocks that are appreciating in value. How long can this keep going without a social upheaval? While this has been going a long time, since 2010 at least, asset prices can also hibernate for a long time, such as the period from 2000 to 2009, in which the average annual return of the S&P index was negative. Now, on with our second observation, which is that asset prices fluctuate more widely than those of consumer goods. In fact, the one recent year in which the consumer price index was negative was 2009, and the last one previous to that was 1955. Even in those years, the CPI was very close to zero. By contrast, the S&P had 18 years of negative annual returns since 1955, while the median home price had 7 negative years. Clearly, it would seem that housing is more closely aligned with consumer inflation than stocks. However, if you subtract mortgage rates from house price increases, the negative years would jump from 7 to 30. Of course, if you derive additional benefits from investing in real estate, such as living in it or tax benefits, then it would make sense to have exposure to that sector. Otherwise, the stock market is the better bet. Let's conclude. We know that buying assets is generally beneficial and will beat consumer inflation in the long term. But let me share my little secret about when to buy or sell in the short term. Assets generally appreciate when interest rates go down and appreciate when they go up. And we know that the Fed tends to lower rates when the CPI goes down and increase rates when it goes up. So, following the CPI is a great way to time asset purchases and sales. Right now, for example, I expect the CPI to go up thanks to the war and oil supply issues, so I wouldn't be making major new investments in the stock market.